and then we'll try to look to go in person in October. So again, welcome everybody. Good to see you here today. And Matt, if you'd be kind to pick it up and take it from here.
Yeah, absolutely. Thanks everybody for being here. Dad, thanks for starting the call off. So we have two people on our call here today. We have Melvyn Peters and David Rudman, who's still waiting to hop on the call here. So I'll just introduce Melvyn, and I'm sure David will be hopping on in the next couple of minutes. But Melvyn is a vice president at the DAC Group. He supports the middle market business clients as they navigate the M&A landscape. So in his role as vice president, he combines his in-depth financial analysis experience and comprehensive industry knowledge to identify value and opportunity for clients. So Melvyn, thanks for being here today. And we will shortly be having David Rudman, president, founder of Sigma Valuation Consulting. His experience includes providing forensic accounting and business valuation for marital dissolution, corporate advisory, tax compliance, M&A, ESOPs, mainly in the real estate space. So we should be having him on shortly. So wanted to start the call off, and I know you guys have a little bit different backgrounds here, Melvyn. You're more on the M&A side, and David more on the valuation side. But just kind of curious if you wouldn't mind discussing the current M&A landscape a little bit. How have things changed since COVID was in full swing? Just curious kind of what you've been seeing out there.
Sure, happy to answer. Thanks for having me. If anyone has any questions, feel free to interject. It's not a big group, so happy to hop around outside the itinerary that we have prepared. So as it relates to the M&A landscape, I mean, compared to where we were with when we were in the full swing of COVID, things have changed quite a bit. There's a few major trends that I'll talk a little bit about, but overall, from a volume standpoint, 2019 versus 2020, transactions in the North American M&A market were down about 24% year over year. Q4, however, was very strong. It was actually stronger than Q4 2020 than Q4 2019. And Q1 of 2021 is trending up. So activity has certainly recovered, and there's a few different reasons for that. One of which is just the amount of capital that needs to be put to work. So bifurcating between strategic and financial buyers, which we'll probably talk about a little bit later. Both have a lot of capital, especially the financial sponsors, a lot of which were sidelined. And there's a mentality, if you don't use it, you lose it. And obviously they don't want to do that. And as their funds mature, they need to get capital out, whether for add-on acquisitions or platform acquisitions. For strategics too, it's back to kind of executing on the strategic plan. Now that compared to when COVID was raging, there was a lot more rescue financings and work about really just bridging liquidity and kind of going back to the core strategy and kind of thinking about that versus doing deals. From a digitization perspective, I'd say that's the biggest trend that we're seeing. There's deals that we've done 100% remote. I think out of the 10 or 12 deals we closed last year, about half, we leveraged certain things that we hadn't used before. So we used drones to do facility tours. We had different types of interactions with buyers. So we introduced something called a fireside chat, which is a less formal version of a management meeting. And just generally through due diligence, there were some deals where the buyer and the seller never met until after the deal was closed, if that. So I think those are all areas where things have kind of changed, and we're pleased to see where things are now. But compared to where we were with COVID, Matt, it's night and day difference.
Awesome. Well, thanks, Melvyn. David, welcome. Sorry for
Sorry about any confusions. I was having a hard time getting in.
No worries. It's okay. Appreciate you being here. So we did give a brief introduction, and kind of wanted to throw something. I guess this would kind of be for both of you guys, but in terms of areas business owners should address before going to market, can you talk a little bit about some of the wealth transfer opportunities before going to market?
Yeah, definitely. So we are approached all the time by investment banks and some of our referral sources, and they're always coming to us in a rush. Hey, my client has a potential deal on the table, and we need to quickly do some estate planning to get this moved into trust so that when the value pops, it's out of the estate. When we talk about business valuation, the first thing we need to really address is standard of value. There's a difference in the standard of value for gift tax purposes versus what one might expect to receive if they were to go to market to try to sell an interest or to sell their company. The standard of value for business valuation with regard to the IRS and for gift tax is what we call fair market value. You can think of it as, I mean, the definition is, it's a transaction between a hypothetical willing buyer as opposed to a specific buyer with strategic motivations. It's a hypothetical willing buyer in the marketplace. But when I think about it, I really think about it as, hey, we're valuing a business based on its operating fundamentals, cash flows, et cetera. It's an intrinsic value of the business. When we start talking about going to market, we're talking about really a strategic value or a valuation that would be, based on, demand in the marketplace that often leads to a difference between value and price. When we talk about gifting, usually we're talking about transferring non-controlling interest in a business. So I'll give you a quick example. You've got a business worth $10 million. Dad wants to transfer 10% to a trust for the kids. 10% of $10 million is $1 million. We can come in and discount that value by 40% because dad's transferring a non-controlling interest that lacks control and is not considered to be marketable. What we find often happens is by the time we're getting the call, there's already discussions taking place. Sometimes there may be letters of intent. So there's a rush to get, letters of intent are non-binding, but it creates a trail with the IRS that, hey, we're looking to go to market, which creates marketability and starts to injure those marketability and valuation discounts. One of the things that we talk about is when we go into the M&A world, we're talking about a specific buyer, whether it be private equity or a strategic buyer. The value is often very different than the intrinsic value of the business for tax purposes. So you really have a situation where there can be some arbitrage. Imagine I value a bit, I'll give some practical examples, but in the M&A world, we're talking about strategic motivation. 1 + 1 = 3. Different than, the value of the business being worth 1. Company A could be acquiring company B and be able to eliminate significant part of the administrative infrastructure of the business or combine it with other businesses to achieve economies that the business wouldn't have on its own as a standalone. So they may be willing to pay a significant premium over the intrinsic value of the business to acquire it. In the private equity world, it's really about supply and demand. I mean, there's far more money sitting on the sideline looking for quality acquisition targets than there are quality acquisition targets out there to be acquired. And what happens? I own a business, may have an intrinsic value that's low for tax purposes, but I go to market and I have a bunch of private equity firms competing to acquire my business. The price gets bid up. It's just supply and demand. So you really end up seeing a difference or a divergence between value and price. Dr. Aswath Damodaran, who's one of the most internationally famous valuation professors at NYU Stern, if you Google him and you Google Damodaran price versus value, you'll find his 40-page PowerPoint presentation. He's got a very in-depth presentation online that discusses the difference between value and price. And this is really what I'm talking about. I have seen a lot of deals with my clients that have done estate planning over the last few years, and I have two that come to mind. We did one with you guys have all seen these calendar apps where somebody wants to schedule a meeting with you and they say, hey, book it right on, you see the open slots right on their calendar and you can go and book your meeting. We have one of these clients that wrote one of these programs. It's a subscription service. The company had a 409A from last September that valued the business at $392 million. And We came in and did a valuation 2 months later and valued it at about 411 million. And 2 months after that, at the end of December, they did a deal at a notional $4 billion valuation.
Yeah.
Okay, we used a discounted cash flow approach. We even looked at some market comps. Obviously, they had to be discounted to take out the strategic value premium. But here you have a notional, it was a $130 million raise, but the notional valuation was $4 billion. It's crazy. Somebody was willing to pay it. It doesn't mean the company is worth that in terms of value. That's just the price. We had another client a couple years ago that made a dog bone series of products out of vegetable material, totally organic. We valued the business at $45 million. He sold it within the year after for $280 million. And that was this client's third play. First business he sold for 80 million, the second for 380 million. This was the middle one for 280 million, sitting on a yacht in the Caribbean right now. We had some clients that, a couple of women that made a hair care product that catered primarily to ethnic population with kinky curly hair and the oils and the stuff that Black women tend to use on their hair, different hair care products than Matt Jack.
I'm gonna say I use it.
David,
What about beard care products, David? Beard care, that's what Matt uses.
So we valued this business, and then they got approached by private equity. We valued it for tax purposes. My client came back to me and said, "Hey, listen, we've been approached by private equity. What do you think the most our business is worth?" I said, "Listen," I can only tell you intrinsically what it's worth. I can't tell you what someone's willing to pay. I said, "But send me your most aggressive, your absolute most aggressive projection, and I'll run a discounted cash and I'll tell you what it spits out." We came to 40 million. That's about the best that we could, the highest we can get it with the lowest discount rate, the most aggressive input assumptions. Somebody, a private equity firm that approached them was offering them 50 million with another 50 million of earnouts. So there's just this, the market is different. There's a difference between price and value. That's the bottom line. One, supply and demand, I scratch my head every time I see it. I'm like, how could somebody afford to pay this much for a business that, how does it make sense?
I think to your point, David, right? It's worth whatever people are willing to pay. And, based on supply and demand, I think we've all seen over the last year, not every business has, had difficulties. Some have actually done better than others. So
yeah, but I also, and Melvin, maybe you have some insight on this, but I feel like the whole private equity space to some degree is one big pyramid scheme where they're acquiring and combining, and they hope to eventually flip it at a greater multiple. But, at some point you can't go higher, and you can only flip something so many times.
Yeah.
I get the concept.
I guess this is a question for Melvin and Michael. Are we at a bubble? Like, if you're describing what happened with the real estate bubble, David, right? And what happened with the .com bubble. Are we at a bubble? I don't know what Melvin and Michael think.
There's a lot of different ways to unpack that bubble question. And to your point, David, before about is private equity a pyramid scheme? Maybe, but not really. I think it depends on what segment of the market you're talking to folks at. But I definitely think that there's a cryptocurrency bubble going on for sure right now. And I think there's extreme amounts of speculation there. And I think depending on what sector you're looking at as it relates to public markets, which I think some other folks on the call are probably better advantaged to talk to that than I am, especially within tech, we've been seeing rampant speculation, but also the rise of the retail investor. It's funny, but there's all these different memes. If you go online, they end up getting picked up by CNBC, but they're making fun of how ridiculous some of the frothier valuations are right now in the marketplace. I definitely think that from a speculation standpoint, that to me is the biggest indicator that we're in some type of bubble. And I definitely think it's probably more in the crypto and the tech spaces But as it relates to, and we can unpack that more afterwards, but just to answer David's, or talk a bit about what David mentioned, private equity, I mean, there's some hindsight and survivor bias, right? I mean, there's always going to be those sellers of privately held businesses that end up getting an aggressive multiple for their business, right? They might exit for, 10x what they went for and a tax basis valuation. But then there's a lot of other examples from an M&A perspective where companies don't necessarily have the wind at their backs. They're experiencing significant headwinds like a lot did during COVID, or frankly, they just want to exit a business. We represented a client called Jimmy's Cookies. They're based in New Jersey. They are a premium cookie producer, mostly on the private label side, serving mass market retailers, grocery stores, and food service. And they acquired an asset out of Campbell's. It was a bread business called nj.exit.planning.chapter. And they really didn't pay. They paid below fair market value for the business. But what they gained from it was a certain amount of equipment, foray and entree into new customer bases and new category, since they were almost exclusively focused on cookies. And they also solved a significant capacity issue that they had. They went from being at close to 75% capacity to being around 45% total production capacity. So when we eventually go out to market, or they get to a point where they'd like to raise capital again, they've solved a lot of issues that otherwise would have hindered them from a strategic perspective. Now, again, as much as there's buyers that are paying significant coin, there's also buyers that aren't paying as much. But in some cases, a seller just wants to be rid of a headache. And I think that's something to keep in mind as well. Specifically on our end from private equity, I think there's a difference now, and we saw it with fundraising start to kind of decrease in the last year, 18 months, as it became harder and harder for funds to be successful. And there was only so much capital to go out during COVID. Fundraisers are coming back, but there's also funds that aren't hitting the same IRRs or internal rates of return that they were before. So whereas before, a private equity firm might look to get a 25 to 30% IRR, a better return now might be 15 to 20% IRR. That's tied to a few different things, but for one, valuations are going up in some ways. Interest rates are really low, but they're not going to be low forever. And what we saw during COVID was the cost of debt, and a lot of you on the call probably know this, but private equity firms typically like to have at least some type of debt on their deal. So leverage could be anywhere from 50-50 debt to equity ratio to higher than that. But a lot of different factors kind of driving that. There's still private equity firms though in the lower middle market where we would call it 20 to 400 million, where they say, hey, we want to buy a company. It doesn't need to have any institutional capital. It doesn't even need to be optimized from an operational or sales and marketing perspective. We'll figure all that out, but we'll execute. There's also groups that come and say, we'll just buy a few companies, we'll roll them together, build a platform, and we'll use the buy approach versus the build approach. But I think a lot of private equity firms, to your point, David, as much as the really successful ones make it look like a pyramid scheme, there's a whole graveyard of funds that have done really poorly or got burned in the last 18 months. And that's, again, it's survivor bias, it's hindsight bias. We don't necessarily hear about them. We just hear about the folks that are hitting home runs all the time. But one of the things that we try to do when we're running a process is due diligence on some of these groups to make sure that that a fund is solvent. And if there's a situation where, say, a business owner has an opportunity to roll equity in an entity that's purchasing their company, we understand what the valuation is. We make sense of how they got there. And another area we haven't talked about is EBITDA adjustments, but even private equity firms, we use pretty ridiculous EBITDA adjustments to justify a valuation when they mark to market sometimes.
So if I can ask you guys, some of what we see in investment management is that portfolio allocations have increased so much of their private equity allocation in the last few years. There's been so much money in the space, and that's one of the reasons it's been driving up the price. But to follow up on Gary's question, I guess my question would be, what would make the bubble burst? Would it be a lot less money coming in the space? Would it be interest rates that get to a certain number? Would it be tax code changes? What do you guys see as what you think would be things that could really turn the market from some of the excessive sale prices that we're seeing now?
Hey, Dave, if I could say, I would jump in on one point, because to say yes or no to the question, is there a bubble? In general, there's pockets of bubblicious, for lack of putting it better. But I think in the lower middle market, businesses in that, say $1 million to 10 million of EBITDA, even 500,000 to 10 million, it's kind of a perfect storm. And it's a combination of tons of capital, low interest rates, and there's also the demographic factor of the baby boomers. On top, if we put the pandemic aside for a second, but a lot of the buyers that we see that are doing these roll-up strategies, they're happy to pay 7, 8, 9, 10 times EBITDA for maybe businesses that years ago never would have got that multiple, because they're adding it to the pile and they're selling the big pile for 15 times EBITDA. So if they're at a point in the investment cycle where they know their exit is a year away, they don't mind paying 10 times for, $1.2 million in EBITDA right now, because that same $1.2 million, they're going to sell it for 15 times as part of the bigger package. So when I look at the whole thing, to answer that, what's going to stop it, the strategics have already pulled back a lot. And I've talked to some strategics who normally play in that same, they say we'll look at businesses that size. They don't even want to participate in the process. So, they've kind of taken themselves out. I think we come back to risk and reward, so what people are paying 10 times there's no margin for error. So I don't think there's a bubble per se. There's definitely pockets of areas where there is, but I think this environment is going to continue because the lack of quality situations are causing the small and medium-sized firms to pay more for assets than maybe they should. And to Gary's point, not because maybe it's worth it, but it's because the perceived value is going to be there, it's a very interesting dynamic. I don't know what slows this part of the market down. Personally, I'm glad that we focus on it, because the demographics, I think, are the biggest headwind, in addition to, the low rates and abundance of capital chasing the situations.
Michael, I also think there's an element of there's always a bigger fool, right? I mean, a lot of these private equity firms need to spend money, and all of their LPs, whether it's high net worth individuals, pension funds, whomever, they're seeing all the other private equity firms and alternative asset managers working hard, putting money to work, and at a certain point, that's also something that's driving up the price. And because firms missed out last year, not the strategics but the sponsors, they feel like they need to deploy. At the same time, we're running processes for deals of different sizes and different industries all the time. So companies that are in, say, the dealership space and automotive versus a building products company versus a SaaS business focused on healthcare technology. Very different responses depending on quality of asset, but also depending on, to your point, where we are in the cycle related to that industry. I'd say, again, is there a bubble? I think there's pockets of bubbles, to your point, Mike. I really think crypto is a bit of a bubble, but I think regulation is something that's definitely going to potentially pop, or at least kind of scale back these bubbles. From a cryptocurrency perspective, there's a lot of speculation there. Regulation will always kind of bring that back down. I think from a technology perspective, especially within big tech, the Biden administration has made pretty clear that they're looking pretty hard at the industry as a whole. We've seen in Europe that France has done a good amount, as of some of the other countries in the Eurozone, to kind of combat the influence of big tech. And I think that even though we've seen a pullback, and it's been somewhat kind of muted, not extreme, at least so far this year, from tech compared to last year, more into basic industries, that's another area to be careful. And again, inflation fears. I mean, I try to ignore some of the gyrations of the market in the short term, because they're always going to be there. But there's definitely been some whipsawing based on inflationary fears. And that's an area that I do have concern about, because that directly affects whether or not, we ascribe to, the price of something versus the perceived value. Even if interest rates stay low, but then they start creeping back up, that obviously affects economic output from a leveraged buyout perspective if you're a sponsor, if you're doing capital budgeting as a strategic buyer. And overall, I mean, there's a few different ways that the market can become more tepid than it is now.
No, I think you're spot on too with the inflation too, because I think as we saw in tech over the last 3 months, it's harder to justify these crazy valuations when inflation's going up and interest rates are going up. So I think, kind of going back to the bubble question, it's almost like, are the inflation fears and interest rate fears stronger than the lack of supply out there in the market? So should be interesting to kind of see over the coming months. But Melvin, I thought the DAC group was putting out their own cryptocurrency. Are you guys holding back on that?
Yeah, we're gonna put out some DAC coin.
Okay.
So let me know if you want to get in first round. We're giving 20% discounts to the
I already love the name, the DAC coin. It's good. It sounds like it's like one of the best crypto names out there.
It's got a good name. Hey, if one can be based off a meme on Dogecoin, I think there's some real promise there, Melvin.
Yeah.
Oh, yeah.
Matt, if I may, I got a question for the panel, for David and Melvin, and I guess Michael too. And this is, it's almost, the question I'm asking is mostly for our clients at the Founders Group, but it's also a personal question for my wife's business. From what I've heard today, it almost sounds like if you have an attractive business that's ready to be sold in a decent to good space, take the money now, because you may not see multiples this high for a while. Almost like the New Jersey housing market now, right? Like if I didn't have to buy another house, I would sell my house tomorrow, because it's just crazy what people are getting for their homes. Is it the same for businesses right now? Would you advise clients that are considering selling, all other things being equal, to do it today?
It's a good question. If I think back to the last 5 years, or even the last decade, we had the longest expansion after the great financial crisis since Reconstruction, since the Civil War, from an economic perspective. I don't think anyone expected it to go as long as it did. I don't think anyone expected the coronavirus to happen and to kind of upend the global economy for almost a year, and we're still recovering from that. I think right now it's certainly a seller's market. I'd be surprised if valuations get much higher, but then again, I think a lot of people in the industry felt that way. Probably most of you on the call in 2016, 17, 18, 19. But I do think from what we're seeing from a kind of new business development pitch activity perspective, there's definitely a mindset shift over previous years that normally we'd only see during an election year. And maybe some of the proposed tax changes from the Biden administration are playing into this, but sellers definitely believe what you said, Jeff, about it being a seller's market, it being time to go. I can't say that we won't have this market, at least from a valuation perspective, from a while longer, or for that much longer, just because there's still so much money coming in and groups want to put capital to work. But it's definitely a very good time to sell.
So going back to what Michael said about demographics, supposedly the baby boomers were born 1946 to 1964. So if you look at that from an age perspective, this is when Michael, you said that, it made me think of this, is the youngest baby boomers, right, are turning 57 this year. So the question is, as they get older in the next, maybe we got another 5 years of this democratic trend, maybe another 10, and then it probably will change. Michael, what do you think? Because I'm just thinking about your generational baby boomer comment as baby boomers get older, because the oldest baby boomers born in 46 are turning what, 76 this year, right? So a lot of them may have exited already. Yeah. I'm just curious what your thoughts are on that.
So what I would say, and to answer the question that Jeff, to combine the two, I always start with the person, what do you want to do with your life? Because we all dealt with some owners that are early 70s, and they don't want to sell because they don't want to give up their business. But what I would say right now, if sell, like I tell them that, they say, "Oh, you're pitching your own books." No, I'm not. It's a matter of what you want out of life. And if to sell within the next 3 years, my advice, because I don't know how long this party will last. We've seen enough cycles. And even I'm only 47, I've seen different cycles since college, 96, when I started on Wall Street. Don't try to pick the time. Maybe we're not at the 17th hole, but we're definitely at the 15th or the 16th. And there are forecasts out there. I'm not saying I subscribe to them. I think if you guys ever heard of ITR economics, is who's predicting the late 2020s depression. Do I think that's going to happen? I don't know. I have no idea. I never put much credence to say because they're never right. But if you look at the balance sheets of the federal government, your local state, and think about what's going to happen regardless of who's in the White House. Taxes are going up. Cost of living is going up. There's enough ingredients out there to say, great time to sell, But then I come back to, what do you want to do with your life? Because there's owners that sell and they have nothing to do and they're miserable. So that's the best way that I can answer it. If I was an owner, and Jeff, the real estate, we just renovated our entire house in Livingston. I didn't even want to move in. I wanted to sell it to some moron for 50%. So if I was in the position of an owner who could get a great multiple for this, then I'll say that till I'm blue in the face. If they want to live their life in the next phase of no longer being a business owner. So I try to keep it simple. And that's the way I look at it, regardless of who's in the White House and what these wonderful folks in Congress are going to decide to do or not do.
So I have a question that's like partially a comment. I've been noticing with younger, like Generation X, and with family office type clients that they're looking for different ways. They're looking at farms and anything else that they can do to have safe money. Do you guys see like a significantly different psychology between like the two different? It seems like there's early boomers and late boomers, and then there's Generation X, which is so much smaller. What do you guys, does anybody have some insight on what they see happening when Gen X that wants to build it their way, that doesn't necessarily like to buy something that's already built, or that, sees things more idealistic? Like when that transfer starts happening, what do you guys think about that generational dynamic there?
Good question. I mean, most of the business owners that we work with, and we work with 85% business owners versus say like financial groups, they are in that kind of late to early stage baby boomer era generation. But I'd say from a Gen X perspective, we're working with right now a husband and wife team that own a pediatric home healthcare business. And they're looking at being acquired by a sponsor that has a company in the space already. And they're rolling up a few other home healthcare companies to build a larger entity. And for them, originally when we had talked to them, and this kind of goes back to Michael's point about like, what do you really want to do? Our question was, why do you want to sell? They say, we're tired of dealing with the big payers as it relates to getting reimbursed for the services that we provide. And we just don't have the skill to deal with them. So we want to be out. We want to do our own thing. We totally want to be done. And then as they went through the process and we found this one group, that mindset kind of changed to where they said, maybe we don't want to totally exit. Maybe there's a way to get around the stuff that we don't necessarily like. Maybe we're having a paradigm shift where we'd actually like to partner, roll some equity over and have a stake in a new business. again, it's such a personal kind of decision. To them, they always focus on with their business, you know, we want to provide the highest quality of care for these children, and that's what matters over being profitable. But it just so happened that by doing that, they've been able to maintain higher reimbursement rates than some of their peers in the market that they operate in, which has helped with their valuation. So to this couple, they want to keep doing what they're doing because that's their vocation, if you will. But to another point, I think one of you made on the call is there's a lot of business owners that are just miserable and they don't really know what to do with themselves. So is Gen X more idealistic? I think they are. I think a lot of them might be more serial entrepreneurs than some of the boomers, but maybe that's just because of, and maybe that's just an age element to it because they're so much younger and they don't really feel like they're done yet. Maybe they want that second bite of the apple. And to your comment before, Daniel, about the family offices and farms and other kind of, we'll call it asset classes or investment opportunities, there definitely is a connection to what you mentioned, and let's call it like environmental social governance investing, even though we're seeing that trend in the public markets too, where there's different areas that are totally different in terms of the scope, where newly minted, you know, multi-millionaires want to invest their money, business owners, and we don't spend a ton of time there, but oftentimes when clients end up selling, there has been a change from, okay, who are the wealth managers or advisors that we want to give our money to, hey, these are some of my interests. What do you think about it? Do you know anyone in the VC or the growth equity space or a family office that invests in these types of business or these types of assets? And can you help connect me with them?
Yeah, and thank you for that, Daniel. Just a reminder, anybody else has any questions, feel free to chime in whenever you'd like. Got about 15 to 20 minutes left, but Melvin, just curious, kind of from a deal flow perspective, you know, what types of transactions are you seeing, and are there kind of certain areas of the market that you're seeing are a little bit hotter than some others?
Yeah, I mean, I think overall, like we've all kind of said, deal flow is really strong right now. It's really busier than ever, both from the new business side, but also from an active mandate perspective. I'd say one thing we haven't talked about as much is that strategic buyers are also sellers. A lot of them are carving out non-core parts of their business and focusing back on the core. It's a trend that started last year with COVID, especially when there's maybe underperforming units or ones that were just kind of corporate orphans that ended up being sold off. It's not an area that we spend a ton of time in, but as we talk to some of our peers in the marketplace, they're seeing a lot of that. On the financial side, it's interesting to see that a lot of the trend that kind of goes with certain, let's call it family-owned business sellers or owners looking to sell because they're just tired, they don't want to go through another cycle. We're seeing the same thing on the financial side. And a lot of our clients and members in the ecosystem that we talk to have said that they're looking to exit. And we're aware of a number of private equity firms, whether they're held for 3 years or 10 years, that really want to exit at this time. I think another hallmark of the cycle and where we're at in terms of just how busy we are is the availability of third-party service providers. I don't know if anyone here is working on a deal with one of their clients, but we've definitely struggled to find, let's call it accounting firms that do quality of earnings or provide other types of seller buy-side due diligence services. And it's gotten to the point where some even top 10 firms are turning down significant levels of business in the tune of hundreds of millions of dollars. And we've certainly experienced, and some of our colleagues have experienced, a little bit of a drop in quality just because of the labor shortage and the kind of supply demand imbalance there. But I think generally one of the other kind of hallmarks of this market, which reinforces the deal flow question, is just that there's not enough professionals to go around. And I think that's something that's very unique compared to at least the last decade, because it's not just accounting firms or legal firms, but it's also investment banks and private equity firms. So if you do have a business that, or a client that would like to sell, but you don't think they're ready, unless there's a preemptive offer where a buyer kind of comes out of the woodwork or they're approached on a one-off basis, it probably makes more sense if they're of less scale, if maybe there's some more serious demerits to the business, like a customer or vendor concentration, key man risk, maybe their financial reporting is a little sloppy, to ask them to take more time to prepare. Maybe it's 6 months, maybe it's 2 years, but prepared because there are assets being passed over just because of how many opportunities there are in the market right now.
Thanks, Melvin. Yep. No, I think.
Thanks for promoting my business, Melvin.
Hey man, that's what this group is for, to
Right.
share with one another. So
Shameless plug, but I think we've all probably been hearing that from a lot of business owners, is that one of the hardest things is probably to find labor and to find workers who want to get off, making more money sitting at home than coming back to the office. So I think that's certainly going to be a challenge. I guess this is kind of for both David and
Matt, can I add to that just for a second on that comment?
Sure.
I'm not sure it's just a pandemic issue. I think that the millennials coming through, I think there's been a shift of the labor force in terms of what people, what the workforce that's coming out now want to do. Nobody wants to become an accountant or a lawyer or this. They all want to be social media stars and activists and this and the work ethic. Listen, now I'm going to sound like my father did, right? But and nobody wants to work. But I'm seeing that. I'm not seeing the people coming through the universities and in the numbers that they were coming through before. It's getting harder and harder to find talent at the accounting firms, at the law firms, all over the place, at the investment banks. And I don't think that's just pandemic related. I think it's a cultural shift of demographics and the millennials. And I think that problem's here to stay.
Yeah, and I look at the cost of college, and I think a lot of people that are probably reevaluating that right now, and you're
Yep.
even less graduates coming out. So what does that look like for the workforce? I think it's a great point.
yeah, Jeff, to your point, one of the things that I've noticed as we've been, we've hired 4 or 5 people this year, is that as it relates to colleges and whether it's undergrad or business school, but especially business school, 20, 30, 40 years ago, you'd think, okay, you get an MBA, you're going to go into strategy consulting or finance, and you're going to really chase a front office role. And then maybe you go out, you become an entrepreneur after, you do your own thing, you leverage that experience. I think in the late 1990s, the average, I'd say, actually, yeah, the stat is 25% of graduates that went to an Ivy League school went into investment banking. Now it's 5%. And that's all replaced with tech jobs. Why? Because the lifestyle is better. You get options and you get equity incentive. You get a hell of a lot of perks. And to the point that you made about the millennials, I don't think it's the millennials. I actually think it's Gen Z, because the millennials are older than we think. I think the youngest millennial is 26 or 27. So even if you look at it at an undergraduate level, all of these analysts and associates at larger banks, accounting firms too, to my point earlier, they're losing a lot of their, let's call it associates, senior associates, to other jobs because of just how kind of hard the lifestyle is, there's definitely been a paradigm shift. And you're right, that is something that's causing certain firms to rethink the way that they treat their juniors. And even I think there was like 13 analysts at Goldman Sachs that put out that report. At first, it was kind of a joke to everybody. And it started off on this Instagram meme account called Liquidity, not liquidity, but a play on liquidity. And then CNBC picked it up. And before you know it, there's $20,000 bonuses at the Jeffries, and Blackstone has $80,000 stay bonuses for like 25-year associates because of how many hours they're working. Yeah. So the fact that that's actually getting traction, look, I think it's ridiculous that people at some of those banks work the hours that they do. I think you could still pay someone a lot of hours to work 60, 80 hours a week, but the amount of hours that some of these guys get worked is really impressive. And I wouldn't put up with it. I wouldn't be doing this job if I worked those hours, honestly. Maybe that makes me weak-minded, but it's just a lot of work that's been going on. And we haven't talked about SPACs at all today because it's somewhat fallen out of favor and the volume of SPAC deals has declined. But that obviously contributed to it a lot because capital markets were down last year. Overall, however, SPACs were this bright light and easy way to raise money and kind of backdoor into bringing a company public.
And just remember, to all you baby boomers out there, you need us millennials to keep working to pay your Social Security. So you got to be somewhat nice to us.
Keep showing up to work, Matt.
But I think we actually do have a professor on the call, Jonathan Willinger. Just curious what your input is, if you've kind of seen anything with just students coming through and feedback that you've gotten from them.
Well, one thing I think about this whole deal with the private equity is there's just so much private equity money out there, and there's so few companies that are really have real long-term value. I know from the pet industry, so I know the fellow that Mark, very close friends with the fellow that Mark Rudman mentioned before, and he and we both sold our companies, and I sold 10 years ago, and my product is still all over all the PetSmarts and so on and so forth, as is his. But there are companies that absolutely disappeared off the face of this earth that had just been acquired in the private equity market for tens of millions of dollars, and they just disappeared. So I mean, that to me is always, the bigger worry, that when there's so much money out there burning a hole in in people's pockets, it's that to me is the biggest worry about that whole thing. And now this, you brought up the SPAC thing, and that SPAC thing is interesting. It's getting a lot of bad publicity, but the reality is, at the end of the day, it's a way for these companies that have gone through 4 or 5 private equity companies, and they've sort of reached the end of the road, to delever. And if if it makes sense, I'm personally of the belief that is going to be a long-term factor in the market, the SPACs, when it settles down. I mean, I don't, obviously there's been a lot of, kind of silly stuff with famous people that they use to track, but I think the net result of this, in a SPAC situation, is there's deleveraging. So I personally think that it makes a lot of sense, and it'll be long term. I'd be interested to know if anybody agrees with me or disagrees with me on that.
On the SPAC front, great estate planning play can be made out of that too, because when you value these things, the sponsor units are usually valued at $10 before they've acquired any kind of target, and there's all kinds of discounts that can be applied to these for risk of forfeiture and the like. I mean, you could discount them heavily as an estate planning play prior to them going out and acquiring their target. We've got about 3 we're working on right now, where we're valuing the sponsor entities prior to their acquisition of the target.
I just want to add, though, that I practiced law for a number of years on Wall Street, and I was involved with some of the earliest leverage buyouts. Before, I didn't hear the term private equity until many years after that. And people thought that was a drop in the bucket. I mean, some of these things disappear, and some of them just gain momentum and over time and morph. And I don't know, I'd just be interested to know if any, if people agree with me that the SPAC phenomena is something that is here to stay. There's always hype, but what lasts does last.
Anytime you have something new, no matter what it is, like derivative, new type of investment, whatever, it always gets people, are beating a nail in with a screwdriver and trying to drive a screw in with a hammer. People always miss you, and so you're like, wow, that's stupid. That's horrible. When reverse mortgages come up, it was like, there's all kinds of bad stuff. And then it's like, well, in some situations, it actually is a really good deal, but it just took us a long time to figure out all the stupid uses for it and all the good uses for it. So,
and some of these areas, there needs to be time for the law to develop and possibly regulations to develop too. So, that happens.
I was on a call yesterday with a client who's got $1 billion valuation through the private equity space, and they're going to be going public probably within the next 12 months via SPAC. I don't know, I see it. I think it's interesting.
I think it's a good, to your point, Jonathan, the deleveraging thing is great. Obviously, excessive leverage can be the opposite of a boon to business. You talk about companies disappearing. Think about Toys R Us. That deal got totally blown up. That was awful. I mean, that was a huge mainstay for decades. However, I think SPACs are good in the sense that there can be alignment between shareholders of the SPAC and those that actually are the private equity firm behind it, or maybe those with management interests. but I think frequently that's not the case. And I think that's something where, to the comment about the law catching up, if things can be a little bit more pari passu or a little bit more fair there, obviously I think the incentives make sense to, with lack of a better term, incentivize the management teams. It's great. But if it's just a mechanism for financial engineering and there's really nothing there but bluster, then I think that's partially why I have an issue with it. Because a lot of the SPACs that I have followed, the utility of it hasn't really been from an intrinsic perspective. It's been more from a financial engineering perspective.
You know, the other question is, how does it affect our, the markets that we're interested in? How you can't take a middle market or a small company public through a SPAC, but how will it affect, assuming it does continue, how does it affect the small and middle market?
I mean, I think it's probably going to be certain SPACs that do a majority buyout, or they do an acquisition of a larger company and then they go to continue gobbling up other companies. So maybe maybe some of our clients in the future won't be directly related to that SPAC raise or buyout, but it'll be kind of a secondary component to it. But I think, I don't know what the biggest SPAC has been lately, but there's definitely some SPACs in the few $100 million range. They're just not as publicized, but I don't know. Do you know what the smallest SPAC has been so far? I've only really spent time with some of the bigger SPACs, not as much.
Well, I think they go. I mean, the smallest ones in terms of the market cap, I believe, are in the $400 to $500 million range, that's why I said it doesn't. The impact would be, expansion of SPACs through existing ones that have an operating entity. Yep. and buy other companies. That would be the impact. But I would think, there's been so many in my field, in the pet industry, there's been so many companies that have gone through, multiple, someone was mentioning that before, multiple private equity houses. And at a certain point, how many can you go through? I mean, it just, you wonder what's going to happen. So I would think, the answer, and there's only so many strategic buyers, in many of these fields. So I would think that these SPACs there's a market there that I think, it adds some risk for the seller because you can't really liquefy your position completely. But I think it makes a lot of sense. I think it will continue to happen, but we'll see. I don't know, in the pet field, BarkBox just did a SPAC today or yesterday. And I think that makes some sense. I mean, it's a significant company. They've really done, they were one of my first, I was one of their first suppliers, and I was honestly skeptical about the concept, but they've done really well. They have 1 million subscribers, and I think that's something that can continue to grow. So, I mean, it's just like all of this stuff. There's going to be some things that work out, and be interesting how they grow and how it does affect related markets.
I think we should have in a year from now, a follow-up, Jonathan, to talk through the SPACs and see what's changed. Maybe we'll get some regulations, and maybe Elon Musk will permanently be banned from Twitter. But I don't have a crystal ball. So.
Yeah, well, I think what happens often with some of these things is they kind of get a lot smaller before they sort of become institutionalized and grow. As I recall, that kind of happened to some extent with the whole LBO market. I could be wrong about that, but.
Yep. No, it definitely takes some time for some of these things to get adopted and for the market to feel comfortable. But I like Melvin's idea. We could do a 1-year follow-up on the SPAC from here, and John will have you on the panel for that. So, but no, just wanted to be respectful of everybody's time. Thank you so much for everyone's input today. Thought it was a great call. Just wanted to make one announcement. We'll be skipping our July meeting, like my dad said. August 4th, we'll be doing a peer share. It'll be similar like this, but we'll just be an open forum. And then September will actually probably be our last scheduled Zoom call. We're going to plan to meet in person starting in October, and we'll keep you updated on that. So hope everybody has a great July. Stay safe out there, and hopefully we'll see you all in August.
Great to see everybody. Take care, folks.
Bye, everyone.
Take care.
Thanks,
Bye,
panel.
guys.
Thanks, Melvin.
guys.
Thanks,
Thanks,
David.
everyone.
Thanks, everybody.
Yeah.